What if I told you there's a completely legal way for a retired couple to earn $166,300 and pay absolutely zero federal income tax? And I know it sounds impossible, but I'm about to show you exactly how this works using recent changes in tax law that most individuals are ignoring. I'm Bob Wolfe, certified financial planner and IRS enrolled agent. After working with families over the years, I can tell you that understanding these tax rules could literally save you hundreds of thousands of dollars over your retirement years. Now, before we dive in, everything I'm sharing today is strictly educational and should not be interpreted as specific tax, financial, or legal advice for your situation. I'm going to break down the most recent tax law changes that make this possible, show you the exact breakdown of income, and explain why the tax planning world has fundamentally changed, but most people haven't caught up yet. Let me start with what's changed, because if you're still operating under old tax assumptions, you're leaving some serious money on the table. First, the One Big Beautiful Bill permanently extended lower tax brackets and higher standard deductions. Remember, all the panic that was of 2026 tax rates jumping up, that sunset never happened. The lower rates of the Tax Cuts and Jobs Act have now been made permanent, and the standard deduction actually got a small boost. Second, we now have a senior deduction. Starting in 2025, if you're 65 or older, you get an additional $6,000 deduction per person. For a married couple, that's $12,000 extra, and it's available to couples with modified adjusted gross income up to $250,000. Third, required minimum distributions don't start until age 75 now. So that's 3 extra years without forced distributions from your traditional retirement accounts that allows you some more flexibility with when you want to realize income for your best tax advantage approach to your retirement planning. These three changes completely reshape retirement tax planning, but what most people don't understand about how tax brackets actually work is the key to understanding how to leverage this to the fullest extent for you. Our tax system is not just one big bucket where everything gets mixed together. It's more like a layered cake. And understanding these layers is the key to your entire strategy. But first, let me address one of the biggest tax myths that I encounter. And I'm about to talk about a myth that even many tax professionals believe. Nearly every month, I come across somebody who does not want to sell their stock because they were told that their capital gains would push them into a higher tax bracket. But here's the truth. Long-term capital gains, as long as you hold it for a year, cannot push your ordinary income into a higher tax bracket. Period. They are calculated separately and distinctly from your regular income. It's honestly pretty shocking how widespread this misconception is, even among people who should know better. Here's what actually happens. Your ordinary income, wages, traditional distributions from retirement accounts, business income, interest on bank accounts, those get taxed first. Then and only then do your portfolio income, dividends, and capital gains get stacked on top with their own separate tax treatment. These flow through a separate bracket that begins at 0% and quickly flows up to 15 and 20% above certain thresholds. Understanding this is critical because it means that capital gains can never push your ordinary income into higher tax brackets. They just sit on top. Your deductions wipe out that ordinary income first, which is exactly what we want since ordinary income faces higher tax rates. There are plenty of times where I find that individuals are happy to have a negligible or minimal tax bill, but when we think about the tax code and the ordering of income rules, we end up realizing that we leave a lot of money on the table based off of false information by not registering this ordering function. Now, going back to our example of $166,300 of zero taxes, let's walk through an illustrative example of a retired couple, John and Sally, both age 65, retired, who are strategically delaying Social Security benefits to maximize their future claims. We're going to keep Social Security to the side for now for simplicity's sake so that we can illustrate the way that our tax income structuring works and how we can engineer our income in a way that we're paying the lowest possible taxes over time. Our first component could be one of several things depending on your situation. Number one, a traditional IRA distribution if you need the cash flow flexibility. Number two, a Roth conversion if you want tax-free growth going forward. Three, an inherited IRA distribution if you're required to take one anyway. Any sort of work income, any sort of ordinary income. The key is that this income matches this couple's total available deductions. The math being a standard deduction of $31,500 plus $3,200 for the additional deduction for being over 65, plus $12,000 for the new senior deduction. That's $46,700. I'm using $44,700 to leave room for a strategy I'll show you in a moment. Now, the second key component of income to understand here is long-term capital gains or portfolio income. This is where things get really exciting and where understanding that capital gains myth becomes really crucial. Maybe this individual bought Nvidia early, or Tesla, or Bitcoin, or they just had a diversified portfolio that's done well over the years. They can harvest $96,700 in long-term capital gains or qualified dividends and pay zero taxes on it. Why? Because long-term capital gains have their own tax brackets completely separate from ordinary income and calculated subsequently. The first $96,700 of long-term capital gains for a married couple filing jointly is taxed at 0%. Now remember, these gains don't touch how their $44,700 of ordinary income is taxed originally. The ordinary income gets its deductions, gets taxed at the regular rates, and then the capital gains sit on top with their preferential tax treatment. The third component here would be tip income. So here's the new tax law that gets really interesting. Under the One Big Beautiful Bill, up to $25,000 in tip income is fully deductible. Now, I work with individuals all the time, and many don't want to completely stop working. Work provides structure, social relationships, purpose. I have individuals who work part-time at golf courses, country clubs, restaurants, not because they have to, but because they want to. So Sally decides to work part-time as a server at the local club. She makes $25,000 in tips, which is fully deductible under the new law. The total, $166,300 in income, $0 in federal taxes. Let's talk about what this means over the 4-year window from 2025 to 2028 when these rules are guaranteed to be in effect. $166,300 times 4 years equals $665,200 in total tax-free income. Think about that for a moment. If you're doing conversions, taking distributions, that's nearly $180,000 moved from traditional future taxed accounts to either Roth accounts or distributed for more flexibility in the future. That money will grow and can compound tax-free for the rest of their lives if moving into a Roth account. If individuals choose to harvest more capital gains to fill up their 0% bracket, that could be $387,000 in gains realized with zero taxes. We can reset our cost basis, eliminate future tax drag, and keep every penny. Now let's look at the bigger picture here and talk about how tax planning has changed. The conventional wisdom about aggressive Roth conversions and always choosing Roth over traditional contributions was based on the old tax environment. When RMDs started at 70.5, then 72, and we thought tax rates were going up, it made sense to consider paying more taxes earlier and avoiding them later. If the goal is to pay taxes when you pay the least, we need to adjust our thinking. For many people, the sweet spot might actually be later in retirement when these enhanced deductions and lower rates apply. But understanding how these laws are changing, our actual standard deduction, and the ordering rules is critical knowledge to know on a year-by-year tax projection basis when to accelerate income and when to defer income. Based on what I've seen with the families that I work with, here are 3 ways to optimize this ordering approach. Number 1, strategic timing around Social Security. The window before you claim Social Security is a golden window. No Social Security income means more room for these lower brackets to be filled. Consider delaying Social Security while maximizing these tax-free distributions or conversion opportunities. Strategy number 2 could be coordinating with charitable giving. Instead of giving cash to charity, we can donate appreciated securities directly you can avoid the capital gain tax entirely and still get a charitable deduction if your deductions are high enough. The last strategy, and the most important one being, is a multi-year tax planning strategy. It is crucial not to think year by year, but map out a general framework for 4 to 5 year plan from 2025 through 2028 to maximize the guaranteed window of these enhanced deductions. Some years you might emphasize conversions, others distributions, others capital gain harvesting based off of your specific situation. Now, I need to be clear about something. This exact scenario requires specific circumstances. One, you need to be 65 or older. This would change your deduction if you're lower than this, but our concept of ordering still applies. You need appreciated assets to harvest to take advantage of the lower capital gains bracket being filled up. Third, your income needs to be low enough to qualify for the senior deduction, which begins getting phased out $150,000 for a married couple or $75,000 for a single. Fourth, you need to be comfortable with a tip income strategy or just put it to the side and say, that's the nice to know. But even if you can't hit all $166,300, understanding these principles can save you tens of thousands of dollars. And it's the type of planning that I facilitate annually with the families that I work with. A couple earning $100,000 through strategic distributions and capital gains harvesting could still pay zero federal dollars in tax. The tax planning world has fundamentally changed in the past 3 years, but most of the advice you're hearing is still based off of old rules. If you're approaching retirement or already retired, it's time to revisit your assumptions about how aggressively you should pursue Roth conversions, whether traditional or Roth contributions make more sense, when to realize capital gains, how to structure your retirement income, and the opportunities are there, but they require understanding of how these rules and the income ordering interact with each other and dispelling the myths that are holding people back. So, the bottom line, can you really earn 166 grand and pay $0 in taxes? Under the right circumstances, absolutely. The tax code has specific provisions that make this not just possible, but completely legal and legitimate. It's not just about how much you make, it's about what type of income you have, when you realize it, and how you structure it. If you found this helpful and want to see how these strategies might apply to your specific situation, I'll be available for a personalized review for a retirement tax strategy to make sure that you're not paying more than you absolutely have to the IRS. The tax planning world has changed. The question is, will you change with it? Thanks for watching, and I'll see you in the next video.